What's going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so don't miss future videos. So I'm back doing videos. Yes, I did post my grade school videos for my buddies that I played football with. I'm back focusing on the niche of income investing, high yield investing. Yes, I did lose a few subscribers, I think 10 or 11, but I can make up for that pretty quick. So there are some weekly pay ETFs that I don't have in my dividend portfolio. I'm hoping M1 Finance adds to the dividend portfolio. I'm going to show you a few of them that are on my radar that I think are somewhat safe. Of course, it's not financial advice. There's no guarantees, but these companies have done very well. And I'm assuming with the weekly pay that might be okay. Again, when the market goes bad, you're in trouble. So you have to be very careful with that. But they're pretty good. So let's check out these weekly pay ETFs right now. First one that I'm really looking at is the Roundhill Berkshire B weekly pay ETF. Berkshire Hathaway is a huge company, and there's Berkshire A and there's Berkshire B. This one follows B. So again, it's been down a little bit because of the market, 43.77. It's slowly starting to trend back. You notice when the market was taking a hit, it was a little bit off. Past 6 months, it went down a little bit. Again, the market was a little iffy starting in July. Past month, again, 5 days, and past day, it's been up. So with the market going up, hopefully it'll be stable. Again, there's no guarantees, and you have to be very careful because I'm going to briefly go over them. You have to be careful because if you look at the overview, now the distribution rate's 22.1%. That's good. That's not too bad. That's not too crazy of a high yield. But the Roundhill Berkshire B Weekly Pay ETF is designed for investors seeking a combination of income and growth potential. Now, Berkshire B, great company, growth company. A lot of people have them in their IRAs or portfolios for growth. It aims to provide weekly distributions and calendar week returns before fees and expenses equal to 1.2 times or 120% the calendar total week return of Berkshire Hathaway and the common shares of Berkshire B. So again, there is no guarantee that it will successfully provide returns that correspond to approximately to 1.2 times or 120% of the calendar week total return of the common shares of Berkshire B. So what has my interest is the weekly distributions, the enhanced exposure, and yes, the powerful combination. Now you have to be aware that there's an expense ratio of 0.99%. Now I'm going to be very clear to you guys, you shouldn't be buying things because I buy things. There's a high risk with these. I can take a hit. I did take a little bit of a hit with HOOW, and it is what it is. Hopefully it'll rebound, but I'm not 100% invested in these weekly pay ETFs. I use these weekly pay ETFs to buy dividend growth stocks. These weekly pay ETFs go to zero. I'm okay. I don't think that'll happen, but again, they go to zero or the fund's gone. It's really not going to hurt me that much because again, I have dividend growth stocks. I have good companies like Procter & Gamble that hike their dividend quarterly. I have Exxon. I have Starbucks. I have JP Morgan. I have some very good companies that are dividend growers. So in financial sector stocks, I have good high yielders. There's just time to start turbocharging the dividend portfolio. So again, the distribution, if we look at it, it's weekly, like I said. So it's about 18 cents a week. You're not going to get like a superstar number. Now, there was 1 week it was 77, but you're not going to get superstar numbers. But just the numbers and with a company like Berkshire, I feel a little bit more safer. But you should still be on your toes and keep an eye on that. This isn't like investing in the S&P where you're expecting it to grow each time. in your growth IRA or your growth portfolio or your brokerage account or QQQ, because QQQ's done very well. I mean, look at the numbers, they speak for themselves. I mean, there's a risk investing in that too. It could go down, but this is a little bit more riskier. So, it can go bad. S&P, I don't assume that that's going to go bad. If there's a huge market dip, I'm going to be buying the S&P more. I already expect the S&P to go up. This one, I expect it maybe to be stable, but not jump up significantly. Let's jump to the next ETF. I kind of like this one, the Roundhill Amazon WeeklyPay ETF. Amazon's a really good stock, a really good company. And anytime you're driving on the highway or you see people get stuff from Amazon, Amazon is a very powerful company. Very good growth company, very good growth potential. So I'm looking at, if I buy a WeeklyPay ETF like AMZN WeeklyPay ETF, I want to make sure that it's a good growth stock to help maybe keep it stabilized. Now it's down right now. One point it started off at 48.59 and it's in the 50s and it went at 49 and it's 43.63. Market's been down a little bit and this is a nice rebound from 42.59 right here. So just be aware of that with the risk of these. Now, I own a few of these, but these are ones that I'm looking at closely to enhance my dividend portfolio. And this is a good company. Look at Amazon. So let's jump to the distribution. Again, it's 120%, just like the previous one that I went over with Berkshire, BRKW. Same thing, 1.2% or 120%. This is a good income ETF to turbocharge my dividend portfolio. These people that want to live off passive income with these, I don't think that's a good idea. Now, is it good to get some play money with it, when you retire? Why not? Who's going to say no to making an extra $100 a week or something with these WeeklyPay ETFs? But you need some reliability. Like SCHD is reliable with dividend growth. VIG is good for dividend growth with an ETF. Procter & Gamble, I mean, they use their products all the time. I mean, I own Starbucks. I mean, again, reliability. But again, this is a nice little oomph for turbocharging my dividend portfolio and buying dividend growth stocks. So let's jump to the distribution. Now again, a 0.99% expense ratio. Now the distributions aren't bad. I mean, 40 cents, 29, 24, 40, got 51, 33. That's not a bad distribution for weekly. And if you look at the trends, again, I always say study the trends. Look at the price go up. Look at the comparison between things. The trends aren't too bad. Price per share so far has been okay. We got to make sure if the market takes a big hit and this goes down, because of Amazon going down, people are panic selling, things are going on. This can take a significant hit. So this is why I emphasize, don't have all your eggs in one basket. I just think this one's a little bit, and again, this is not financial advice. I just think it's a little bit better than the other ones that are less volatile is stocks. And again, of course, the more volatile, the higher the risk, the higher the reward. But look at MSTW or MST or MSTY. MicroStrategy is taking a big hit because of crypto. Amazon, I mean, just look outside how many Amazon trucks are going on. Look at the Amazon data with it. There's a reason why I have Amazon invested in my growth portfolio. I want money from Amazon. I expect my net worth to increase because I own Amazon stock. I expect my IRA to do well because of Amazon stock. I expect the really good ETFs that have Amazon in it to grow because of Amazon. So that says something right there. Now I'm going to jump to the final one. And this one's a really good one. And I highly like this. I mean, it's up there, okay? it's up there. The Roundhill Google WeeklyPay ETF. So Google, I get paid on YouTube for income. Google makes money. GOOGL, GOOG. This is a really good one for income. 75.98. So when Google goes up, this goes up. Now look at how well it's done. It's up 49.04% since inception, which is fantastic. That's what I like about this. This is why it's such a powerful weekly pay ETF. And I'll show you the distribution, which is really nice. So in September, 48 cents weekly distribution, 79, 54, 68, 52, 57, 56, 63, 55, and now it's in the 70s. So since Google's a good company, this is going up because of Google. So this is one thing that's very impressive. I like my HOOW. I've done really well with HOOW. I'm down a little bit, but it appears to be coming back up, which is nice. But look at the way Google's done. And this is why I feel safer with these type of 3 ETFs. Now I have to wait on M1 Finance to add some of these ETFs. They're taking their grand old time. And again, I'm going to emphasize this. You shouldn't really rely on these for retirement, this income, because it's up and down. How would you feel making 50 cents one week and then 70 and then 40? I mean, the reliability is not there. It's great to have some play money. Don't get me wrong. If you like making $100 one week and then $300 a week and then 400, I like consistency. This is why I don't think the reliability is too high there, but I use these ETFs to buy dividend growers. Now, eventually, I'm going to flip it, and I'm going to receive income from these weekly pay ETFs. But I want to have enough income that my dividend growers and my consistent ETFs and dividend growth stocks and dividend stocks and high yield dividend stocks are giving me the passive income that I want and I feel confident with. I don't feel completely confident with this. Yes, I'm going to buy it. I do have a small percentage, less than 20% of these weekly pay ETFs. But again, I want quality. I want consistency. These are not the most consistent for me to retire on. It's great to get some play money. You know, I can throw it around here. I got to flip it this time around. I got to max out my IRA. I got 2K more I need to throw in it. And I need to build up my bank account when taxes come in March. And then what I want to do is max out my IRA on the spot and probably max out my health savings account on the spot. And then I'm thinking about maybe moving or relocating. So I need some capital to get rid of, to get out of a certain area if needed, or relocate. That ain't cheap. Moving companies aren't cheap. So think about that. So again, I'm going to use this income for other purposes other than retiring. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so don't miss future videos. I will have a video for you tomorrow. I'm glad to be back. Honestly, it's a great time to recharge and start pumping out videos. I love doing this for you guys. And you know what? I did enjoy posting those videos for the football stuff. You don't have to watch it. I'm just being honest with you. This is my niche. This is my focus. This is what I'm focused on. So I'm going to jump to my disclaimer. So as a reminder, this is a disclaimer. Do not use my YouTube channel for any form of financial advice. It's strictly for entertainment purposes only. Investing is a big risk. You can gain money, can lose money. So be aware and do your due diligence. Go to a financial advisor for financial advice. Go to a tax advisor for tax advice. Investing, you have to do your due diligence. You can lose money when you invest. So this is why I tell you to go to a financial advisor. You shouldn't buy things because I buy things. I'd feel bad if you get burned. And it's not my fault if you lose a lot of money. I'm doing this to show you my passive income journey. Take care and have a good one.